In this video, I'm going to talk about compound interest. Now, you may have heard this quote, compound interest is the eighth wonder of the world, and that was said by Albert Einstein. But what about this quote? The internet is the greatest invention ever, by Abraham Lincoln. Now, the reason why I bring this up is because I'm skeptical about that first quote by Albert Einstein, and it's really difficult to find out whether he actually said it or not. What is compound interest? Well, it's where your interest earns interest. And there's a big difference between the theory and the practice, and that's what we're going to cover in this video. Now, compound interest is a mathematical extrapolation and an education tool that a lot of people in finance use to explain a couple of key ideas. Now, in this, I'm going to focus on compound interest when growing your wealth and the fact that it only exists within a financial calculator or a financial model. There's a difference for debt. Now, in practice, to grow your wealth, it's where your income and capital growth is reinvested back into your portfolio rather than being spent. Here is the typical chart you'll see of compound interest and how it can be used to grow your wealth. Now, the important thing here is that the longer you go out, the more these figures continue to rapidly accelerate. Now, it's best to explain this with an example, and we're going to invest $100 at 5% per annum for 3 years. As that capital is locked away, it's going to generate interest, and that money is going to be reinvested. So you can see it goes from $100, pays $5 in interest, which is going to get reinvested. So you start the second year with $105, and then the process continues to repeat year 3, and if you were to go into year 4 and year 5. So after investing $100 for 3 years, you'd have $115.76, and here's a breakdown of that. $15 was generated in interest. However, the interest on your interest was only 76 cents. Now, the reason I bring this up is because not all compound interest calculators will show you the same information the same way. Here's the Money Smart website, which is run by the government. This is their calculator, and as you can see, it would just give you all of that money in one figure. Now, here's the same data. I've broken it down into individual components, the $100 in capital, the 5% interest that you're going to receive along the way, and then the interest on interest, which is green. Now, I want to highlight this and present it to you another way. And this just shows you what the benefit of reinvesting income and capital within your portfolio will generate. Over time, you can see that there's a significant gain. Now, for me, I think a lot of people don't get to see how these individual components are broken down, and typically they'll just see one big chart and their money's growing exponentially. Now, the reason why I want to talk about this is because compound interest calculators don't include tax, inflation, transaction costs, fees, volatility, or even your risk tolerance. Now, all of those things are going to play a factor when you're looking to grow your wealth, and for me, that's why I think there's a big difference between theory and practice. Compound interest calculators suffer from straight line return assumptions, and that's where the returns are assumed to be constant. Now, rightly or wrongly, that's a little bit subjective. I think it presents an unrealistic picture of the situation because small variations in the assumptions have a large impact over longer and longer periods of time. So here is what a typical portfolio might actually look like. And the reason why I put this in is because I've put this through a Monte Carlo simulator. So it generates the expected stock market returns within a set of statistical parameters. And depending on what kind of volatility there is in the marketplace and the expected returns around asset classes, it just highlights that people can end up with very different outcomes. Now, if you were to put this into a compound interest calculator, this is the projection that you'd get. And I just want to highlight the difference between the two because I think that investors have a certain expectation around how their portfolios and their retirement savings should perform. Now, my key points with this video is that small assumptions in some of these online calculators means that you can generate extremely different outcomes, and those assumptions can lead to very unrealistic expectations. and that can really cause problems later on down the track. Now, compound interest calculators are an education tool, and the general idea is that people should invest sooner to get the benefits of compounding their wealth. Now, there's a lot of people who start investing later on in life for a number of reasons, and the main point here is that all's not lost, because a lot of the time the tax savings with using superannuation make up for not compounding your wealth and starting your investing journey much sooner. So there's definitely a positive there. Now, there's so much more that goes into building your wealth than just plugging some figures into a calculator. So with that said, I think this video is getting a little bit long. Thanks for watching. Stay tuned for more videos. Now, everything in this video has been covered under general financial advice and factual information because it doesn't take into consideration your personal financial goals, needs, or objectives. And that said, you should always speak with a licensed professional before making an investment decision.